Hi, this is Sally's Book Club. Tune in daily as we bring you the world's finest books. Today we're exploring The Intelligent Investor by Benjamin Graham, the mentor of investment legend Warren Buffett. Graham originally developed this work as teaching material for his investment courses at Columbia University. Known as the father of value investing, Graham's principles shaped modern financial analysis. Buffett famously said 80% of his investment philosophy flows from Graham's teachings. He even named his son Howard Graham. Let's examine a case study to understand value investing in practice. In 1926, 32-year-old Graham made Wall Street history with a landmark transaction. Northern Pipeline Company, a Standard Oil spinoff, had a market cap of $2.8 million. Graham discovered the company held $3.6 million in railroad bonds through public filings. The hidden assets might have been strategically concealed for various business reasons. Now consider this. If Graham found this data publicly available, why didn't others act on it? Most investors lacked Graham's unique insight to capitalize on such opportunities. His innovative approach created a blueprint for modern security analysis. Graham quietly accumulated Northern Pipeline shares through his investment fund. He later sold these shares at substantial profit when the discrepancy became apparent. While later adopted by hedge funds, Graham was the pioneer of this strategy. But does this qualify as true value investing? Strictly speaking, no. Graham himself cautioned against such methods in his book. Such opportunities are rare and unpredictable by nature. They typically require institutional scale capital to execute effectively. Retail investors risk significant losses without insider level understanding. Though this made Graham famous, he never recommended it to readers. Paradoxically, the master tactician wrote a guide protecting ordinary investors. Buffett notes in the preface that Graham generously revised the book through 4 editions. Today we're examining the definitive 4th edition, spanning approximately 600,000 words. Let's explore the book's essence through 3 key questions. First, what defines an intelligent investor? Second, what should intelligent investors buy? Third, when should intelligent investors buy? And when should they sell? Master these 3 questions and you'll grasp the book's core principles. Let's begin with our first question, defining the intelligent investor. This question revolves around 2 key terms, intelligence and investment. Graham argues that financial intelligence isn't about IQ or academic credentials. The definition of investment requires deeper examination. Graham establishes 3 investment criteria: thorough analysis, principal protection, and reasonable return expectations. Transactions lacking these qualities constitute speculation, not investment. Simple in theory, but challenging in practical application. During 1929 and 1932 Depression America, stocks reached historic lows. Many believed only bond purchases qualified as true investment. A 1948 survey showed 90% of respondents disapproved of stock investments. Yet by the 1960s bubble, stock trading became widely accepted as investment. History constantly repeats itself. China's A-share market sees similar patterns. Value investing, preached at peaks, ignored at troughs. Distinguishing investment from speculation remains profoundly challenging. So how do we differentiate them? Graham offers 2 straightforward principles. First, margin trading by non-professionals constitutes speculation. This principle implicates most margin users in China's A-share market. Second, chasing popular stocks is speculative behavior. Graham permits limited speculative activity with segregated funds. Graham categorizes investors as defensive or enterprising. Defensive investors seek satisfactory returns with minimal effort. Note, defensive not equal to lazy, enterprising not equal to diligent. Crucial distinctions. This book will challenge such common misconceptions. After finishing the book, you'll sense Graham persistently discouraging active investing. Graham advocates steadfast adherence to defensive investment principles. If still aspiring to be enterprising, assess if you meet Graham's criteria. The term enterprising investor shares etymology with entrepreneurship. Graham asserts that becoming an enterprising investor requires treating investments as serious business ventures. This means following established business practices. First, being thoroughly knowledgeable about your operations. Cultivate professional relationships with investment experts and understand their workflows. Young aspirants might consider internships in financial institutions beyond just investment firms. Second principle, never delegate core decision-making responsibilities. Third, only pursue ventures with verifiable profit potential through rational calculations. One effective method is drafting formal research reports for each investment decision. Fourth, maintain conviction in your expertise and experience. Execute decisively when supported by factual analysis and sound judgment. Adhering to these principles likely indicates existing business success. Lifelong employees without entrepreneurial experience should reconsider enterprising investing. Graham's ideal enterprising investors possess both wealth and leisure time. These requirements exclude most retail investors from qualification. Graham endorsed young investors using modest capital for educational experimentation, but they must approach as learners, not market-beating aspirants. Graham's tripartite investment criteria clearly distinguish speculation from investment. The intelligent investor rejects speculation, focusing solely on true investment. The book addresses portfolio construction as fundamental question. Graham dismisses permanent solutions against inflation. Only balanced stock-bond portfolios can preserve capital long-term. Graham recommends stock allocations between 25% to 75% of portfolio. The remainder should be allocated to bonds or low to moderate risk products. Graham rejects the notion that low risk equals low return or vice versa. Defensive investors should follow 4 stock selection principles: adequate but not excessive diversification. Focus on large, well-established companies with strong financials. Prioritize companies with long-term dividend payment histories. Use PE ratios relative to 7-year market average minus 25x during Graham's era. These criteria effectively exclude most growth stocks. Enterprising investors may consider growth stocks with thorough documentation. The book warns against high-yield bonds, foreign bonds, and IPOs for active investors. Graham generally discourages growth stock focus for individual investors. Retail investors struggle to outperform institutions in growth sectors. Active strategies require 2 principles: fundamental stability and differentiation. First principle, ensure basic return stability. Second principle, employ strategies distinct from mainstream approaches. Essentially, avoid strategies already adopted by the majority. Thus, Graham couldn't explicitly recommend specific strategies. Any published strategy would become common knowledge. The book nevertheless suggests 3 historically effective approaches. 1. Overlooked large cap stocks with low PE ratios. 2. Undervalued stocks trading below net current assets. 3. Neglected secondary companies within industry sectors. Similar logic applies to second-tier stocks in China's A-share market. Beyond stocks, the book discusses fund investments. Graham considers funds suitable for defensive investors, but fund selection requires careful analysis, not passive buying. Historical data shows most funds underperform indices. Still true today. This underperformance represents normal market dynamics. Graham cautions against funds potentially using speculative strategies. Short-term gains often come at the cost of decade-long recoveries. Graham prefers closed-end funds trading below NAV without sales charges. China's Yubao serves as a modern example of low-cost fund distribution. Internet platforms reduce distribution costs, challenging Graham's sales fee assumptions. Convertible bonds gained popularity in China's A-share market recently. Newly listed convertibles often surge 10 to 30% within initial trading weeks. Graham remains skeptical about convertible bonds' promised returns. Complex contractual terms frequently contain hidden pitfalls. Many convertibles ultimately underperform plain bonds due to fine print. Warrants receive harsher criticism as speculative instruments. China's warrant experiment ended abruptly after speculative frenzy. This validates Graham's warnings about derivative instruments. Graham dedicates significant content to timing strategies. His conclusions contradict popular technical analysis methods. Essentially, candlestick patterns and moving averages prove ineffective. Graham systematically debunks market timing strategies. First casualty, trend following strategies popular among Chinese traders. Dow theory showed promise late 19th to early 20th century, but underperformed buy and hold from 1938 to 1968. Trend strategies work well during strong market movements, but generate excessive false signals during consolidation phases. Mass adoption exacerbates market volatility dangerously. Retail investors can't compete with institutions in high-frequency trading. Second flawed strategy, simplistic buy low, sell high approach. This strategy has failed spectacularly across global markets, including China's A shares. Attempting to time market bottoms or tops violates fundamental investment principles. Third criticized strategy, formulaic investment plans. Similar to grid trading methods used by some Chinese investors, buying incrementally during declines and selling during rallies. Graham notes practitioners may secure partial profits but miss major opportunities. Such systems only accumulate positions during downtrends. Long bull markets leave these investors sidelined indefinitely. Share investors often exit positions prematurely during major rallies. This approach frequently misses the most profitable market phases. Market volatility represents noise rather than opportunity for wise investors. Graham poses a fundamental question. Sell on price appreciation? Holding through fluctuations neutralizes emotional responses to price changes. Graham suggests mechanical portfolio rebalancing between stocks and bonds. This serves psychological rather than financial purposes. A behavioral remedy against emotional decision-making. Common A-share trading strategies face comprehensive rejection. So, when should investors actually transact? What constitutes valid entry or exit criteria? Systematic approaches remain essential for disciplined investing. Two profit avenues exist: market timing versus valuation analysis. Timing focuses on price movements, valuation on intrinsic worth. Technical analysis falls under the flawed timing category. Valuation-based strategies compare price to calculated fair value. Graham strongly advocates valuation-driven approaches. Modern investors overemphasize price action, neglecting fundamentals. Price fluctuations reflect market sentiment toward book value premiums. Exuberant markets drive prices far beyond rational valuations. Irrational panic selling creates opportunities for disciplined investors. Implement valuation strategies by ignoring market noise, focusing on dividends and corporate fundamentals. Buy decisively when price falls below intrinsic value. Consider selling when exceeding it. Financial analysis remains crucial for determining intrinsic value. Graham's methods require adaptation for Chinese markets due to different economic contexts. Compare stocks' 7 to 10-year average price to earnings ratio with market average as reference. Shanghai Composite's PE reached 69 in 2007 bull market, plummeted to 9.8 in bear market. The recent 7-year average PE hovers around 15. Stock A's current PE of 8 masks poor historical performance with 7-year average over 40. Stock B's 15 points per exchange aligns with its 7-year average of 13. Clearly, Stock B better suits defensive investors. Graham defines growth stocks by recent 2 to 3 year growth rates exceeding historical averages. Growth stock valuation formula: projected growth rate times 2 plus 8.5. A PE of 40 implies required 15.75% annual growth rate, common in China's GEM board. Investors must assess sustainability of high growth projections. Margin of safety forms Graham's investment philosophy core. Safety margin shrinks as price exceeds calculated intrinsic value. No inherently good or bad stocks, only safe or dangerous prices. Most retail losses originate from buying junk stocks during bull markets. Graham acknowledges possible safety in select growth stocks. Growth valuations rely more on future projections than historical data. He concedes some Wall Street analysts make accurate predictions. Growth stock risk lies in excessive market premium formation. Diversification only reduces risk when overall market conditions are safe. Graham's roulette analogy, betting $1 on all 37 numbers. Can this strategy profit? No. 35 payout creates 2 loss despite single win. Investors should recall this analogy when diversifying portfolios. Key takeaways from this book. First, pursue investment over speculation. All margin trading constitutes speculation. Second, defensive strategies suit most investors. Only those with significant resources should attempt active investing. Defensive portfolios should hold 25% to 75% stocks, large, stable, dividend-paying companies. Third, active investors should primarily hold fundamentally sound stocks. Adopt valuation-based strategies. Buy below intrinsic value, sell above. Fourth, prioritize safety. Overvalued markets render diversification ineffective. This concludes Graham's classic framework. China's A-share market remains dominated by technical traders. Most investors chase excess returns rather than accept market averages. Graham observed, achieving satisfactory results is easy. Exceptional results extremely difficult. Investing reflects life philosophy choices. Investing constitutes a multi-decade marathon. Your chosen path determines both financial outcomes and life trajectory. Our intelligent investor analysis concludes. Keynotes available below. Until next time.